Hello everyone, my name is Kéthlyn and I'm presenting our work titled Systematic Review of Portfolio Optimization in the Brazilian Financial Market, Integrating News and Fundamental Indicators with Deep Reinforcement Learning. This study was conducted by myself and my co-authors Débora Fernandes, Márcio Fernandes, Fabrício Soares and Thiago Monteles de Souza from the Federal University of Goiás and the State University of Goiás. The presentation is organized into the following sections. I will start with an introduction to the topic, then walk through our systematic literature review process, delve into the background concepts, and explore the results of our review. Finally, I will wrap up with conclusions and suggestions for future research. The Brazilian financial market is a substantial entity generating approximately 1.36 trillion reais in revenue in 2022. Despite its importance, research on portfolio optimization specifically tailored to the Brazilian context remains limited. Our study sought to address this gap by conducting a systematic literature review focused on the integration of deep reinforcement learning with two critical elements: Portuguese news sentiment and fundamental financial indicators. So the primary objectives of our work were to conduct a systematic literature review on integrating deep reinforcement learning with Portuguese news and fundamental indicators, and to understand the current state of research, identify prevailing trends, and highlight opportunities for advancing the field. To achieve this, we conducted a systematic literature review with the purpose of identify, analyze, and synthesize relevant research. This process was guided by the well-known Kéthlyn framework, and we used the Parsifal tool to organize and manage our analysis. Our search focused on four major databases: IEEE Explorer, ACM Digital Library, Scopus, and Google Scholar. We also applied strict exclusion criteria. For example, we excluded duplicated works, studies published before 2019, or those not available in English or Portuguese. Our systematic review was structured around four research questions like: are there studies using deep reinforcement learning for portfolio optimization? What deep reinforcement learning methods are employed? Are there studies that address the use of deep reinforcement learning together with indicators based on news in Portuguese to optimize a portfolio of financial assets? What fundamental quantitative analysis indicators are used to optimize a portfolio of financial assets? These questions guided our analysis and ensured a focused exploration of the topic. And we used keywords related to financial market, deep reinforcement learning, fundamental analysis, Portuguese news, etc. And after applying search filters and exclusion criteria, we identified 35 relevant articles from an initial set of 721 articles. And before presenting our findings, I will briefly discuss two fundamental concepts underlying our study. First, the Markov decision process, or MDP. This framework models sequential decision making, where outcomes depend on the current state and chosen actions. It is defined by states, actions, transitions, and rewards, making it well suited for financial modeling. It helps structure problems in a way that's ideal for reinforcement learning. And the MDP is defined by the tuple SATR, where S is the set of possible states in a process, A denotes the available actions, T is the function that calculates the transition probability from state S to S prime when performing an action A, and R is the function that determines the reward or penalty associated with an action performed in state S. And deep reinforcement learning, or DRL, combines reinforcement learning with neural networks, allowing us to learn complex strategies that adapt dynamically to changing environments, such as financial markets. And deep reinforcement learning applications in portfolio management focus on optimizing asset allocation by leveraging historical data to enhance decision making and maximize returns. This figure illustrates the structure of a deep reinforcement learning model, where an agent interacts with an environment by taking actions, receiving rewards for each action, and transitioning to the next state. Through training, the agent learns to identify the optimal action to take in each state, ultimately maximizing its cumulative reward. These two concepts provide the theoretical foundation for applying deep reinforcement learning in portfolio management. And our analysis revealed the following insights. Research on deep reinforcement learning for portfolio optimization has grown significantly, with most studies published between 2020 and 2023. And the majority of studies focus on the United States and Chinese markets. And common algorithms applied in these studies include deep deterministic policy grading, or DDPG, proximal policy optimization, or PPO, and deep Q-learning, or DeepQN, as we can see in this figure that shows the distribution of deep reinforcement learning techniques across selected articles. And performance metrics such as the Sharpe ratio and total return were frequently used in these articles. And studies that use fundamental indicators applied indicators like return on equity, profit margin, and leverage ratio. In the Brazilian context, we identified very few studies. However, the limited research available highlighted promising results when deep reinforcement learning was combined with Portuguese news sentiment analysis. And from our review, two significant observations emerged. Deep reinforcement learning consistently demonstrated superior performance compared to traditional portfolio optimization methods, underscoring its potential. The integration of news-based and fundamental indicators is notably underexplored, particularly in the Brazilian financial market. We identified a significant research gap in the application of deep reinforcement learning within the context of the Brazilian financial market. And currently, there is a scarcity of studies that focus specifically on Portuguese news or incorporate Brazil-specific market indicators. Most existing research tends to rely on global datasets or English news, which may not capture the unique economy, social, and political factors that drive Brazil's market dynamics. This creates a critical area for further investigation. Developing tailored deep reinforcement learning applications that account for the specific characteristics of the Brazilian financial market, such as Portuguese news and fundamental indicators of Brazilian assets, presents an exciting opportunity. By addressing this gap, we can create more accurate and effective models that improve decision making and performance in the Brazilian financial market. In conclusion, our review underscores the growing interest in deep reinforcement learning for financial applications worldwide. While the global potential of deep reinforcement learning in finance is undeniable, our findings also highlight the significant gaps in research, specifically focused on the Brazilian market. To bridge these gaps, future research should prioritize integrating Portuguese news sentiment and fundamental indicators with deep reinforcement learning methodologies. This integration is crucial to capturing the unique dynamics of the Brazilian market and improving the effectiveness of deep reinforcement learning models in this context. Furthermore, developing portfolio optimization strategies that are tailored to Brazil's distinctive market characteristics, such as its economic, political, and cultural factors, will provide valuable insights and practical applications to both the financial sector and academic research. By addressing these critical areas, we can advance deep reinforcement learning applications in Brazil, paving the way for more accurate, localized financial strategies that could serve as a model for other emerging markets. Thanks for the attention.